My name is Jorgen Lian. I head up the equity shipping research at the DNB Markets out of Oslo. And I have the pleasure to invite you all today to listen in to a panel discussion on the dry bulk shipping market. And with me on the panel, from my left, I have Dr. Anastasios Aslidis, CFO of Euroseas and Eurodry. And then I have Mats Boye Petersen, COO of Pangaea Logistics Solutions, with us as well. I have Mr. Hamish Norton, President of Star Bulk. I have Mr. Weernink, founder of SwissMarine. And all the way on the other end, I have Mr. Petrone, Vice Chairman of Navios Maritime Partners. So together, I hope we can figure out what we should think about this market as we go forward. It has definitely been a very interesting period with a lot of views, both in the positive and some in the negative direction, I would say, that have put us where we are today. And I'm very much looking forward to understand how you see this going forward. Now, dry bulk shipping, roughly 50% of demand relates to China. And we tend to talk a lot about China, but to start things off first, as that might be somewhat of an oversimplification, I will start asking the panel, other than China, where should focus be among investors these days to determine the potential for dry bulk? And I'd like to start perhaps with you, Hamish, on that question.
Mm-hmm. Well, there are a lot of places that ship dry bulk and accept dry bulk. Japan is a major consumer of dry bulk. South Korea is a major consumer of dry bulk. India is importing a bunch of coal. Vietnam is importing a bunch of coal. Grain goes to many places around the world. China came, sort of into the market in 2003 and is basically in a big way. But, apart from iron ore, there are many places. This is why the dry bulk market is so complex, because unlike the tanker market, it's really everywhere to everywhere. It's not just a few routes.
And on the, I guess, on the supply side as well, at least when I talk to investors, there's a lot of focus on the constricted supply of vessels going forward, which is a safety, I guess, for a view that this will continue to be a very interesting place to be. How about you, Anastasios, on the supply side of things?
Yeah, indeed, the supply side is the bright spot of the dry bulk markets. I mean, I have been a great believer that the restricted supply would be the foundation for the market to really show us significant growth in terms of rates and prices. It's important to note that supply has been at historical lows. By supply, I mean the order book to fleet ratio. That has been at historical lows for the last 3 years, which means that the fleet is under-ordered, so to speak. There was a hope that that would translate to good rates and prices if demand recovered and returned to normal or higher levels. That hasn't happened yet. I think we all have been waiting for the dry bulk market to do well. I think demand has not turned out as positive yet, but supply still remains to be constricted, so that thesis remains. If you break down into the supply, it's a little bit of a diverse picture. The Capes have the lowest order book, but at the same time have the youngest fleet. Panamaxes and Supramaxes, speaking more broadly about those two sectors, have an order book that is a bit increasing recently, but they have a bit older fleet age profile. So we'll see. I think we have good support for supply side for the next couple of years and look forward to see demand developments.
And I encourage whoever on the panel who has a comment to try and get in touch with me, and we can continue the discussion. So go ahead.
Yeah, I just combine some demand side and supply side. Here's the real macro picture. It helps me get a feel of what's going on. 20 years, we've got the dry bulk fleet has tripled from 300 million to a billion tons. And cargo's only doubled. So we shouldn't be where we are at these rates. But ton miles have more than doubled, actually 2.2 times. So the key here is not just outside of China, is where is it coming from and where is it going to and how long is it taking? And, you know, with this whole idea with Guinea and the bauxite and the iron ore, I saw some research that said if the projections are correct, the 136 capes that are on order will be taken up just by that flow of iron ore and bauxite. So I think that's why you've seen a lot of the older capes being bought out. I think a lot of Chinese receivers are seeing the same numbers. So I'm very optimistic, even though China's always been a worry for us. You know, in 2000, we were talking about, Hamish said about when 2003 and 2004, when things blew up, we were so Western-centric, nobody cared about China. And now we're all worrying about China for the last 20 years.
To continue a bit on the order book and the supply side, I thought maybe I'd ask you, Mats, because part of the reason here, I guess, has been that rates haven't necessarily been sufficient to really drive that ordering wave in dry bulk yet. What's your view on the new building potential where we are today?
No, we agree with that 100%. The market is sort of in a strange equilibrium where running ships makes sense. We're all doing well on that, but it's not really there to support the new building prices, right? It would be a pretty big bet on the market for you to do that, and for us, we never really were big players in that space anyway. We always grew primarily through second-hand acquisitions. But of course, with new environmental regulation coming along, that drives up cost of the new buildings and also the complexity in the decision making. So it feels safer just not to do anything.
Thank you. And then if we turn a bit back to China, because what we see, at least on our data, is that, and as was mentioned, tons haven't necessarily grown as much, but there's been a lot of beneficial movements in terms of ton mile with, improved trade routes, etc., that have tightened the situation. But there is somewhat of a paradox, because a lot of those volumes, even though they've been sourced from further afar, they're still ending up in China. And with the situation that we're seeing today with the steel industry struggling on the basis of a flailing real estate sector in China, it seems somewhat of a paradox, right? And I can ask you, Peter, what do you see in this market that has actually, kept markets decent, I would say, or rather strong this year, considering all the negative headlines that we get out of China?
Stock building.
Stock building?
Stock building in China, Suez Canal, Panama Canal. There's been a fair amount of disruptions and inefficiencies in this market. And at the same time, because you're talking different time frames, right? When you talk about an order book, that's not a next year time frame. Yeah, we're talking there 3, 5, 7 years time frame. Here, the question is about next year. And if you talk about, or next few months, next year, which tends to be more where we as a trading company focus a bit more on. And then we see a lot of dark clouds. Part of the story what kept the market strong is that we've been building stocks on iron ore, we've been building stocks on coal. And basically China, which is a big part of our market, is to us ex-growth. There will be growth in South Asia, but it's on a completely different scale. So if you then look at what we got ahead of us, if you look at the iron ore market, it's hard to be optimistic. If you look at the coal market, the Macquarie has recently put out something where they talk about 100 million ton reduction in coal shipments, seaborne coal shipments next year. Argus and other consultants had it at 50 million tons. If we have a 20 or 30 million ton reduction in coal shipments, we will have a weak dry bulk market. Today is not a weak dry bulk market, historically.
Okay.
Grain doesn't look very supported to us, and certainly China on the grain side is also ex-growth. Bauxite is the one bright spot for the dry bulk. So I tend to be a bit more negative.
It sounds a bit. It sounds a bit like it. I don't know if do you have a comment to that, Hamish? What's your view on that demand?
Well, I think we're a little bit more optimistic, not necessarily in terms of tons shipped to China, but basically in terms of possible replacement of Australian tons with Brazilian and Guinean tons that travel a longer distance. I mean, it's a political question,
For the next 12 months, that's not an issue, right? Guinea bauxite will keep growing, yes. Yeah. If you talk about if predictions of, because people are also putting out predictions of an iron ore price going to $70, $80 a ton, then Australian volumes, larger volumes, seem to me less vulnerable than Brazilian volumes.
Yeah, I mean, it's partly a political question in China. Whether they're prepared to pay to import more from Brazil and less from Australia or not.
That's a tough bet to make.
Yeah, no.
So it appears that China is the key.
I think we can agree.
We tried to move away from China and then we came back to China. But
Yeah, no, well, you have to pay attention to what China does. But I mean, I am somewhat encouraged that China seems to be, aggressively old economy. They seem to be backing off the tech business and emphasizing old economy things that the central government seems comfortable with.
It's easier to stimulate in the
Yes.
nearby term, which is clearly where the focus
Yes.
is shifting at the moment. Question is that enough to change that picture?
Right. We keep waiting for bazookas, and we're getting pea shooters. And
Yeah.
to me, it looks like China's kind of just supporting the downside, so it doesn't fall apart and they stay in power.
I agree.
I just want to go back to my favorite subject, the bauxite, coming forward. Not that we're carrying it; we release our ships out. But I saw a chart saying that by 2 years from now, which is not next quarter or next year, but 2 years from now, in ton miles, coal could be almost as important to the market. Bauxite can be almost as important as coal, because coal's coming down and bauxite's going up, and bauxite's farther away from the end user. So in ton miles, yeah.
Okay, interesting. Yeah, I agree on the stimulus news, which I thought it was very interesting to see how the markets react. I think we're hard-coded in a sense, as soon as there's something about China's stimulus, to think that is directly a positive for dry bulk shipping. Usually it has been, but they were actually very explicit, saying that the way they actually want to do this is by limit a lot of the construction activity that previously has been very beneficial for dry bulk shipping, which is a very important distinction, I would argue.
What's the number? 60, 90 million units they have? I don't know what it is, somewhere in between that are not sold. So that's an issue.
Yeah, and the scary thing is that new build starts of new construction projects is down 60% from peak. And currently the ongoing activity in the real estate sector is only down 20. So what's converging on where, Hamish?
Well, I would just point out that an aircraft carrier is the equivalent in steel of 100,000 cars.
Okay. Okay, yeah, fair point. But there's been a lot of exports.
Electric cars?
Yeah, but there's been a lot of exports on steel as well from China, which is somewhat unusual, I would say. Mats?
Last time, by the way, we had 100 million tons of steel exports out of China was 2015 and 16.
It wasn't a good period.
It didn't work out so well
Exactly,
for
which is
Diversification.
my thought. Yeah, so I don't know. Has that been a beneficial, item for the smaller and mid-sized segment ships so far, or?
I think undoubtedly it's a positive contribution, but I agree with you. If China could consume all that itself, I think it would be a better overall picture, right? Than sort of re-exporting it. It's not a good sign in that sense. It's just they're supporting their steel business to be ready for whenever things turn around domestically.
And currently they export about 10% of their own production. And important to remember, they produce about half the world's steel. And they also consume half the world's steel. So that's why it's a big headache, I would say.
Which is interesting, you bring up that point. I mean, they've been flat for the last 5 years in iron ore imports and steel production, about 1.1 billion, right? Every year and $1 billion. And the market hasn't gone flat. We go back to the ton mile issue again.
Yeah. But I think you're importing 10% more with the same steel production, which is also a bit of a worry, considering the stock build argument, right? That has to end at some point, potentially. So, I mean, at least our case has for a long time been that you've had a lot of tailwinds now materializing on the demand side that actually are still in place to an extent. that might reverse, even if the fundamentals stay exactly the same, which has been part of what we've tried to highlight. But I think you mentioned a lot of these geopolitical disruptions that have been in place. It's not necessarily dry bulk shipping that has been the most discussed in that regards. But Anastasios, what do you think about that? Has that been a major contribution? Let's say you reopen the Red Sea or the war in Ukraine were to end. How impactful would that be on dry bulk shipping?
Yeah, I think obviously when the Red Sea situation emerged, all sectors of shipping were influenced, unfortunately, positively, if you can use those two words in the same sentence. Dry bulk shipping was influenced the least as compared to container ship. So I guess it would benefit the least if it will be affected the least if Suez Canal reopens, I guess. In Ukraine, I think the grain trade will obviously affect it, and more grain trade will go through. So I would say, all in all, that might be a positive if there is more shipments from there.
Well, I think Ukraine, if the war ends, somebody's going to, I think, rebuild the place.
Exactly.
And
So that would be a significant source of source of demand for dry bulk materials. We're saying the same thing with the earthquake in the South Turkey last year, and we haven't seen, I believe, a direct link yet. But all of this, the end of the wars and the rebuilding efforts, the same in Israel and Middle East, would be positive, I would say.
Well, nearby it will be negative. Both Russian and Ukrainian commodities are being shipped fairly inefficiently because a small part of the fleet is only willing to go there. So ships will ballast back to load in Taman, and they're being used fairly inefficiently now. When a sanction situation ends, it will increase efficiencies. When a Suez Canal opens up,
as well, yeah.
Sure, but nearby it will not mostly not be the volumes affected immediately, it will be the efficiencies. Same Suez Canal. Okay, it's smaller on dry bulk, but it's clearly a dark cloud. If and when that changes, which doesn't look like it's happening soon, but if and when that does change, we have it at about 1% of capacity utilization, but it is material. Certainly if that combines with certain other things.
I wanted to ask, since I have two on the panel that have some container exposure as well. Part of the story in the post-pandemic boom on the container side was that you had some transfer of volumes also over to dry bulk. Is that something that has reversed completely, or has the previous sort of spike again in container rates done anything to add that?
I would defer to Hamish on that, but we hadn't seen it. You know, we lease our ships out, and it was obviously a big factor during the pandemic. But now with the rate, you see, the container rates coming off. I would say, if you look at the SCFI, it's probably a 6-month leading indicator to where the rates are going. But it's interesting because containers, it's like the housing market in the States. There's not that many you can get. If you want to go out and get a 4250 or a 6800, you got to pay up for what the owner's asking. So it's kind of I wouldn't call it an artificial market, but it's a different market. The supply and demand there is unique at this point. But they continue to build, right? Listen, IMO is affecting the containers the most, right? They're the biggest ships. You put them all together, same size ships. They weigh them more. They have the biggest engine. They have the biggest problem with IMO. So I think the smart guys are actually building for replacement. I'm not as concerned as others with this huge order book for containers, especially for the niche we're in. We're under 13,000 TEU, which is probably 10% order book. It's like the dry bulk.
Okay. Maybe I would disagree, but I'll leave that for the container panel, I think. But to you, Hamish, do you have any input on that? Because there was an important pull on demand from container cargoes.
Yeah, I mean, certainly in 2021, 22, there were a lot of containers that went on handy-sized ships, and that sort of pushed cargoes into Supramaxes and benefited Supramaxes quite a bit. But I don't think the container rates have been high enough for long enough to push container traffic onto handy sizes. I was hoping it would happen, but I don't think it didn't.
Okay.
Clearly, for most of this year, Ultramaxes have been outperforming the Panamaxes.
Yeah.
I think that's more an issue of Chinese steel exports rather than container overflow.
Yeah.
So that would be the explanation, Chinese steel exports, which have...
And maybe I'm wrong on this, but I think the ships that were affected the most with the Suez have not been the Capes, it's been the smaller sizes. You guys, the Supramaxes have been going the longer routes.
Okay.
So I think it's been good for them.
And Anastasios?
No, I was just to say that I haven't heard any trickling effect of containers going to bulkers recently. So
Okay.
Yeah, I mean, what I hear is what has been going into bulkers actually have been cars.
I was going to ask, because if you start
Yes.
doing the math on that, it could be quite meaningful.
Well, yeah, I mean, basically, I guess it was Costco that came up with this scheme to put racks into open hatch, handy sizes. And the idea was you fill the open hatch ship with, forest products, cargo going to China, and then they put the racks in with the cars, taking the cars back the other way. And these racks have been piling up in ports because there's nothing that carries the racks back to China. But they make enough money transporting the cars that it's okay to use the racks once.
Okay. Interesting. Do you see that as well, Peter? Or is that anything you picked up?
News to me.
No? I've seen the racks, so that's why it's actually pretty
Yeah,
interesting.
no,
they have their own GIF of the wraps, or of these racks that they
Basically, container rates have not been high enough for long enough to put containers on handy sizes, but car carrier rates have been super high for a long time. And, that's basically why it's profitable to put the racks on the open hatch ships.
Okay, good. Thank you. I think we'll jump a bit onto valuation, because part of what the sector has been struggling with has been subpar valuation when you compare to NAV. And it's a typical question I ask in panels like this. What is the advantage of actually being public versus being private when you see the way the markets value your ships? And I think it's interesting directing that question to you, Mats, given that you've just taken use of the being private part.
Yeah,
Or
absolutely.
Public, I'm sorry.
Yeah, absolutely. It took a while, but we're here now, and we just announced a couple of weeks ago a transaction using an all-stock acquisition of 15 handy ships, right? So those are the things, of course, you can see. I mean, especially these days, where the valuations we feel make no sense where the stock is trading, but you find people on the other side of those transactions that see the business similar to what we do and see the long-term value creation. Then you can use that platform, and Hamish and Starbucks have done masterfully to really take advantage of it, right? But it is tough. It's tough going, right? It's no, we don't certainly have the secret sauce or anything, but are trying. And you sometimes, you just got to look longer for the opportunities, I think.
Yeah, but let me ask you that. Let's say you're trading at the 0.7, 0.8 times NAV or somewhere. How easy is it to come across those private companies that are willing to take that as a currency to actually make this type of transaction work?
It's not easy, obviously. It takes someone who is, a lot of things have to come together at the right time, right? But it's, it's a result of I think, our business model, our culture, and how, MTM and Strategic saw themselves in that, and they view it as a platform for growth. They become part of a bigger entity, contributing the ships, and they don't think, quarter to quarter, right? They're long-term thinkers, and I think they recognize the same with us. That's how we run the business, and that's why we were able to have a meeting of the minds.
And yeah, Hamish?
And it's also very dependent on the grace of God.
Yes.
I think in shipping,
This is always a miracle.
Yeah.
part of the success in shipping is to be there at the right time.
Yeah.
So that's why a company like ours, which is smaller than my peers here, remains public, because there is always a possibility, like the one that you were able to capitalize on, that if you are there, you will be able to capitalize on. So, and there are some other benefits on on a more day-to-day basis, the transparency, the fact that that alone allows you to be in contact and be attractive to certain investors. So we find that there are merits in being public, although you may not be able to realize them right away, but being there at the right time, it's important, for us at least.
I think that, Navios used to be 3 separate public companies, and I think it's hard for Wall Street to get comfortable with the volatility in shipping, to be long-term investors. My joke to my Wall Street friends is, if they had the volatility we do, they'd be jumping out of buildings every 5 years like it's 1929. But I think that brought us to the conclusion to put everything under one umbrella. So, because of the non-correlation, like dry and wet is negative. I think containers and dry is 30%. So what we do is we modify our risk profile, right? We do cross-sector opportunities. And I think over the long run, our job is to get the investor group comfortable with a different model. Look, we looked at Japan Inc., private companies that had been diversified families over the years and how they smooth out their profile. And we think, we're 70 years old this year, Navios. I call us really a 19-year startup. And I just think going forward, let's see how it goes. I wish I was 20 years younger, but I think I'm the oldest one on the panel.
I get a bit back to the clear or the pure play versus diversified structures, but a bit back on the valuation and following up maybe with you, Hamish. You've had, I guess, an advantage of being at times priced rather attractively, at least compared to some peers, which has incentivized a few of these transactions. So, and I know we're going to discuss this on the analyst panel as well later on, but what's the key? What do you need to do to get that pricing that can activate these opportunities?
I wish I knew.
Yeah, yeah.
I think size is a big factor on this.
Yeah.
The bigger you are, the better.
I think so, but it hasn't worked recently.
I mean, you are trading very well compared to smaller peers, right?
Well, yeah, but I mean, I think to some extent it's a pass-fail grade, and I think there are gradations of fail. I think to pass, you have to be able to sell equity, taking into account not just the net liquidation value of the hard assets, but also the contribution of the management team to the profitability of the ships. I mean, Star is very efficient at running ships. We have very low costs and very good charter rates, and we make, substantial profits in excess of what the typical ship owner would make. And yet, we're being valued at less than the net liquidation value of the hard assets. Not that there are too many exceptions to that, but it's a difficult, position to be in every day. You have to sort of force yourself to get up and explain to people the benefits of the platform.
Let's and then think about the asset mix within the company, right? Because you grew a lot from being rather balanced exposure against the larger vessels and the smaller vessels. Now, Mats, you've gone and bought small vessels in the small end of that spectrum. Is that an advantage, having a wider array of vessels rather than having a pure play type exposure against one or the other within dry bulk?
I think one of the things that I've been most sort of positive take away from our announcement of this transaction is really the feedback from our customers. They're super excited for us to have this fleet in the mix. We have always operated handies. We haven't owned handies for a long time, but we always have some on charter, and it's a part of our business. But adding 15 ships into the fleet like this gives us incredible service that we can offer to the customers, right? That's really, I think, what it comes down to is that not being dependent on, minimizing your dependence on outside factors, but really sort of taking the bull by the horn and try to develop your own strategy and your own business, right? And that is easier in the smaller sizes than on Capes and Valemaxes for sure, right? So that's what we do. Is all this China talk is fascinating, but I don't know. Did we agree on anything? But so we don't really spend that much time talking about China. We talk about how do we make our offering better to our customers, and how do we I borrow a term from Dr. Vasquez, manage the volatility through reliability, right? That's what we do.
Yeah.
Try to, we won't get the market decision. If we have to sit and guess on what the market does tomorrow, right? We'll be wrong a lot. That's not what we are out there to do.
Okay. And on the, can I then over to you, Peter, a bit, because it sounds a bit like you're talking for the advantage of having the smaller size vessels, right? Would you agree on? It seems maybe you might, considering the view on China and the larger vessels more interconnected with what's going on over there. Which size spectrum would you be on if you had to choose? I would say between the Capes and the Handies or the Supras.
Well, there's different time frames. Obviously, the order book situation is different for Capes versus the smaller segments. The new building prices have moved far further on Capes than on the smaller segments. We operate anything from Capes to Ultramaxes. We have 2 Ultramaxes on order and an 8 Kamsarmaxes post-Panamaxes, and I'd rather have had more Ultramaxes at the moment. Handies we've found for us has been a more difficult segment. We've done it over time. We don't like it as much, but it very much depends what niche you are in and what your customer base is. More to add to that.
Okay.
Yeah, I would think that, you know, for us, RMO has always been, no matter what sector we're in, wet or dry, what do you control as an owner? Cost and risk, that's about it. So what you do is we take our Panamax sub-Capes, Panamaxes, Supras, and we try to put them out on charters, short, medium to long term, according to where we are in the cycle. And then you play the volatility on the big ships. So you set your base, protect the downside, which I've heard a lot when I'm over in Greece. So I think we've done that somewhat successful. And I think that's the way, you diversify between fleets and you diversify within self, because who knows, a black swan lately has been good for shipping, but up until 10 years ago, they've been bad for shipping. And these swans don't originate in the shipping industry. They were outside without any advance notice. So I think to protect the downside is one of our number one, but leaving room for the upside is one of our number one goals.
Well, and let's move then a bit to the pure play versus diversified type structure in shipping. One could argue that the investors could be diversifying by themselves, right? I think the appealing thing to a lot of shipping investors is buying in cheap and getting as much upside as possible, would be my argument. But then there's the volatility, right, which could counter a lot of the interest from especially long-term investors and the type of investors that seem to be the target of a lot of shipping companies these days. And we'll get to Euroseas and Eurodry afterwards, which have a different structure, right, where you keep them separate. But your thinkings on that, Ted, is it always an advantage diversifying in a sector such as shipping, where there's different movements among the subsectors?
There's different investors out there. There's short-term horizon investors and there's long-term horizon investors. And I think our new model has been more attractive to the longer-term horizon vessels. What's interesting about diversified fleets is what we've done successfully is taken a lot of the revenue we have on the container side and go into tankers and dry also. We built some Capes, all contracted out. So I think you get the ability to do cross-sector opportunities from the money you're getting from the high cycle to the low cycle, which is difficult when you're just a pure, one asset play, one sector play. So I think we found it encouraging, our start. Let's see, everybody has a different model. Everybody wants to invest differently. We're happy with the start of this new model.
Can I add to that? A disclaimer, we're a shareholder in Navios. But to me, if the argument is not to be at a discount to NAV, then it has to be partly on what value the management can add. And obviously, when you're a multi-sector, then the room for management to add value in capital allocation, the potential is obviously higher.
If you believe that the management can do a better job than the investor himself.
I tend to agree, because doesn't that optionality have some value as well? Alleviating alleviating the risk and volatility in a very volatile sector in itself. Is that what the shipping investors want?
we have to think there that many of the demand drivers are common, are overlapping across the various segments, right? So really, the differences in the various segments comes predominantly, I would argue, from the supply side. Because most of the demand is driven by general economic growth, one way or the other. I understand there is ton miles and all these other port congestions, etc., but the underlying driver is how well the economies are doing. So to some extent, that argument of counterbalancing the cycles, it has to be done vis-à-vis the supply side of each sector. There, the situation is more clear in front of everybody, and people can make sort of their own decisions. We had a company that had both dry bulkers and containers, and 6.5 years ago, we got enough feedback from our shareholders and decided to spin off the dry bulk fleet. The day with the spin-off traded in the market, the combined valuation of the two companies increased by 50%. From then on, they traded their own ways, each one of them, and of course, container ships did quite well more recently, and the corresponding segment did quite well. So we gave our shareholders the ability to choose the percentages of exposure in each of their portfolios. And right now, we have totally different chartering strategy on the containers, which we are fully booked and have good visibility of contracts and revenues, while on the dry side, because we believe the market will increase, we're fully exposed to the spot market. These two strategies are very clearly presented separately. If you put them under one roof, then I'm not sure what sort of what you're going to make out of it.
I think if a management team can generate absolutely high returns by combining vessel types, that might be valuable. But I think, I haven't seen it done that sort of returns that are considered by the equity market to be sort of absolutely high. It's been hard to achieve over the long term in shipping, with a mixed fleet or with a pure fleet. But I think if with a one vessel type fleet, either just containers, just dry, just tankers, you can get above market charter rates and below market costs. Then it's something that the shareholder can use as part of an investment strategy. And, I think, frankly, even having a mix of long-term charters and short-term charters may be counterproductive for shareholders who may want to use the security as part of an investment strategy where they probably want exposure to the spot market. And so the job of management is doing a good job chartering well, keeping the costs very low, and taking care that the financial distress never causes the company to have to sell assets in a distressed way or raise equity in a distressed way.
And I guess that's part of the advantage, right? Because recently, a lot of dry bulk companies have delevered a lot. Leverage is now really not too interesting, it might seem, to a lot of companies. But I guess that's where you might have an advantage again, Ted, having a diverse company.
Sort of like Michael Jordan, let the game come to you, pick your spots, and maybe you lever up if there's a great deal out there.
Because dry bulk shipping without leverage, is that interesting? I open to answers among.
Well, we have 55,000 vessel-owning days in a year. And so for $1,000 a day difference in charter rate, that's $55 million. That's a huge amount of operating leverage. If we combine that with financial leverage, we're creating a nuclear weapon.
Yeah.
I don't think you need a lot of financial leverage, especially since, we're not getting any tax shield from the interest. If you go back into the guts of, academic financial theory and look at the capital asset pricing model, which I know not everybody believes thoroughly, but in, the theory is that the advantage of debt is the tax deductibility of the interest. We don't get that.
True.
So, I think we don't really need a lot of leverage.
At the same time, some leverage always helps equity returns. So if you have enough leverage not to increase your risk of default, if you go back to
Yeah.
that works best for the returns to the equity.
But
So
that's
there's an optimal level of leverage that.
But, as we all know, the level of debt that will never trigger a default in a dry bulk company.
Zero.
We know what that number is.
But you are never in shipping for the certainty. You are there for the volatility.
Which is a fair point as well. I think we're running out of time, so I want to thank all the panelists for participating. Very good discussion. Thank you all.
Thank you.